Diana Mousina, welcome to Property Insights.
Hello, thank you for having me.
Now, you're the Deputy Chief Economist at AMP Bank or AMP?
It's just AMP now.
Just AMP.
Yep.
But is there an AMP? So does the AMP Bank, the actual banking license, does that fit within the AMP group?
Yes, that's right. Yeah. So AMP has a bank, a platforms business called North, and then Super Investments, which is where I sit.
Yeah. Okay. So you're doing the Super Investments part?
Yes.
So you're giving them economic updates and advice and guidance and whatever have you in relation to.
We do support the whole business.
Yep.
We do stuff for bank. We do stuff for platforms. I mean, it is quite integrated. But our main area is sitting within the multi-asset team within the Super Investments business to give them our economic forecasts, to talk about asset allocation with our portfolio management team. So
just to get a bit of a sense of that, because most people think AMP is full of financial planners. It's not anymore. But AMP is not only is a platform, but AMP actually has products, super products, which are the inventory of a planner. Let's call it that. Can we get a bit of a sense of what size we're talking about in terms of the products?
Yeah. So the funds under management are about $80 billion now. The types of super funds, so we would have corporate super plans. So, for example, if you go into a business and they have chosen AMP as their fund manager, then your default option would be to go with an AMP fund,
unless you choose to do it somewhere else.
Unless you choose to go somewhere else, but that would be your default option. So that's one part of it, corporate super. But a lot of the other super options are ones that are available on our platform, North. So the advisors can choose to use AMP. Now, we don't have many AMP financial planners anymore, and actually that business was sold off at the end of last year, which is to entirety.
Yep.
But that is also part of where people would be investing their money through super via the platform.
But if you're an entirety planner and you're talking to your customers or your clients, the AMP product suite is available to those clients.
Yeah, and I mean, it can be available to people who are just using North. You don't have to necessarily be aligned to AMP. You could just choose a product that's available on North, just like many other index providers would also be on North. So it's just sort of an offering that we have there as one of our funds.
As opposed to pushing it through a planning division, because you guys don't own that planning division.
No, we don't own that anymore. And that really changed after the Royal Commission anyways, because of vertical integration issues.
Yeah, generally speaking, that affected quite a lot of organisations, including the banks. So where I'm interested in, where our audience is interested in, is interest rates, of course, and the economy. So if I just turn to the economy from a macroeconomics point of view or a macro point of view, what do you guys think, what does your team think at AMP in relation to the macroeconomics, and I'm going to tell you which parts of it I'm interested in, of Australia are today. And let's start with just GDP. So I will talk about inflation too, but GDP for a start. Like, in other words, how are we travelling? Like as a nation, one way of measuring this is gross domestic product. I mean, I know it's flawed and that sort of stuff, but how do you think we're travelling in terms of traditional methodologies of measurement?
I think Australia is doing okay, but the more important thing is we're likely to do better in the next 12 months. The last 2 years, our activity in the economy, as measured by GDP, which is basically a sense of production in the economy, how much a business is selling and how much a consumer's buying, it's been pretty soft. It's been running at 1 to 1.5% per year.
Why is that soft relative to some other number? What's the number we'd like to be looking at?
I was about to get to that. Yeah. So the reason that it's soft is because when you think about how much should GDP grow in the future, it should be a factor of how much is your population growing, how much is the productivity growth in the economy, and what's the participation rate of the labour market in the economy. So when you put all those things together, because Australia runs very high levels of immigration, we should be running at close to 2.75 or 3% every single year, growth terms. Right. So compare that to a country like China, for example, they're running at 5% because they have they're trying to get their economy growing, and also when you're an emerging economy, it's easier to have higher levels of GDP growth.
It should be growing much harder.
That's right. So all Western countries generally grow between, say, 1 to 3% year on year, but 1%, 1 to 1.5% annual growth for Australia is pretty low. That outside of the pandemic, that's actually the lowest pace of economic growth that we've had since the early 90s recession, which was more than 30 years ago now. So it was a pretty poor outcome. And I think that's why, especially in the private sector, a lot of people felt like we were in a bit of a recession, and per person, our level of GDP growth was actually going backwards. So that's why people were saying.
As in negative.
Negative, that's right. We had 7 negative quarters of per capita GDP growth up until the last print of December. So for 7 quarters, our economy went backwards per person. And that's generally seen to be a negative for things like living standards.
So and as an economist, if you could just sort of help us out here. So these measurements and GDP per person, maybe you could explain why that's important, because you mentioned it just a moment ago. We tend to always try to measure everything. It's human nature. And one of the things we try to measure is, how well are we living as individuals? What is my standard of living? What can I afford? What I can't afford? What can't I afford that I used to be able to afford? Or what could I not afford in the past I can now afford? That was sort of indicated an increase in standard of living. Standard of living, why is it so important to economists? Why do you guys sort of really talk about it a lot?
Well, there's different ways to measure your standard of living. So there's household income growth, there's productivity growth, there's GDP growth, there's looking at inflation versus wage. I think they are all encompassing of the standard of living. But I guess traditionally, the best way to measure the wealth of a nation is via GDP growth, because it's the production of the whole economy. So that's why when GDP per person goes backwards, that tends to be negative. It shows you that per person, you're becoming less wealthy. I mean,
than it was last year.
Than you were even compared to a quarter ago or a year ago. That's right. So we were actually going backwards every quarter for 7 quarters
on a per person
basis. That's right. And the measure of a recession, according to GDP growth, is 2 consecutive negative quarters of GDP growth, which is why people said when we had 7 negative quarters that we were in a per capita recession. I mean, there are other ways to measure, how wealthy you are as your own household. You have your own, obviously, household balance sheet. We get household wealth numbers as well. Household wealth has actually increased throughout this period, and it's actually increased to a record high because the superannuation balance of the average household has increased so much. Our super system has done so well from very high returns. But GDP is another measure of household wealth.
So is it fair to say, and forgive me for saying this, but these are all fictions, mathematical fictions, because they're all attempts to somehow in a mathematical way and in a statistical way to measure a nation, every single individual. And then if we go and divide it by the number of individuals, we get, like, let's call it a per person number. But they're mathematical fictions because somebody, like, let's say I just make this argument for the moment. I'm one of the people who live in this country. Therefore, technically, over the last 7 quarters, my standard of living has reduced because me as a person in this country, I've endured 7 negative quarters. 7 negative quarters. But on the other hand, maybe my wealth's gone up because all the real estate I own has gone up like quite a bit. So therefore, it's a bit fictional.
I guess it's an attempt. It's a stock versus a flow as well. So GDP is a flow measure. It does change every single quarter. Not that wealth doesn't, but when you think about your own wealth, it is more of a stock-like figure, whereas GDP is a production figure. What has changed over that quarter? So you're just measuring different things, basically.
So, but is that measurement? And I know the media talks about it all the time, but is that measure of GDP per person somewhat a little bit? I wouldn't say misguided, but potentially misleading.
Absolutely, in some ways, but I think every single statistic is, because what is the average household?
Is there such a thing?
And there's not, especially in the last few years. I think we've had such high levels of inequality in terms of asset rich versus asset poor households in Australia, different age brackets doing quite differently in terms of the pain that some households have felt with mortgage repayments, the pain that, for example, retirees might feel with inflation because they're not getting their wages that are compensated to inflation. So it's been quite diverse outcomes. So it's very hard to actually talk about an average consumer.
And it's much more dynamic.
Absolutely.
So so therefore, do you think it would be a good idea, and I know this sounds a bit esoterical, but I think it's important because it's rare that we get actually an economist on the show. Do you think that the media should be encouraged to say, when you, Mr. Media person, write that it's on a per capita basis, we're in a per capita recession. We should also write, though, that there's one part of the economy is doing very well and there's one part of the economy is doing crap. Mm-hmm. And maybe you start to talk about other statistical measures like, for example, the Gini coefficient, like the split between rich and poor and how that's widening. Do you think that we need to have they need maybe to talk, more of them need to talk to you. There needs to be more education of our commentary so that we can get an apolitical view on this stuff and a better sense of how important or how the statistical analysis fits in. Otherwise, it can be misleading for sure.
Well, this is why people try and nitpick whichever parts of the data that they want, because you can sort of find different statistics to suit your point of view. And I suppose traditionally economists and the media have commented on that specific release that's coming out. So it's not like you get all the releases on one day. You get retail sales, you get the home price data, you get GDP growth. So we just naturally just comment on that one bit of data. But it is a good point that we need to keep in mind, the whole range of other indicators. And that's what economists try to do, really, is to digest everything and to plug that into whatever model that we use to try and make sense of actually what's going on in the world.
Do you think the Reserve Bank looks at all those things when they're making their call?
Absolutely.
About what to do with, or we might just wheel back one that wheel back a little bit. What most people don't realise, everyone thinks the Reserve Bank said look at interest rates relative to inflation. Well, that's sort of right, but the actual mandate is the growth and welfare of prosperity and welfare of all Australians. Somehow you've got to measure both of those, but that's part of that's the main part of their mandate. And the way they do it, the way they measure it to some extent is looking at inflation, and then the way they manage inflation is through interest rates. But when it comes to prosperity and welfare of all Australians, what do you think the Reserve Bank's looking at apart from GDP and apart from inflation? What other things do you think they're sort of considering?
Well, the two things that are in their mandate is price stability, which is the inflation target, keeping inflation within 2 to 3% over the course of the business cycle. How long is a business cycle? I don't know. How long is a piece of string? But they have some sort of measurements.
They talk about medium term though, don't they?
Yeah, but what is the medium term? Is it 5 years? Is it 7 years? Is it 10 years? A lot of governors have looked at what inflation has been over the course of their whole term over the course of a few years. Do you take out periods like the pandemic? I think it's open to debate. But yes, I would say on a 5 to 7 year basis, what has been average inflation? So they try and target price stability by having inflation at 2 to 3%. Then their other mandate, they have a dual mandate. Their other mandate is full employment. So keeping the unemployment rate basically as low as possible for the prosperity.
We don't know what full employment means, by the way, and they measure through unemployment. So they sort of say, well, we don't know what full employment means, but therefore we'll look at unemployment.
They have a list of full employment indicators, and I guess historically, we have used the unemployment rate more as a guide to full employment, but more recently, I think it's become a bit more nuanced since the pandemic because the indicators of the labour market have actually been a little bit diverse. We've had some strange outcomes in the employment market. The unemployment rate has been artificially low despite other indicators of the labour market weakening. So there are a few funny things that are going on that I think do have explanations, but it's for this reason that the Reserve Bank basically has a whole list of full employment indicators and it tries to gauge how far away are we from their understanding of where full employment is. But the way I think that there's a simpler way to think about it. When you're thinking about how tight is the labour market, you basically just need to look at wages growth. If wages growth is slowing, it's basically a signal that the labour market has weakened to some extent because if you were still in an environment where things were extremely tight in the labour market, people were competing for jobs, it was hard to find a job, then wages growth should be going up. But in the last 12 months, we've seen that wages growth has actually slowed. It's running at just over 3% year on year, but we were running at close to 4%, if not a little bit above that. So the slowing in wages growth to me is a sign that we're past the point of the peak in full employment. We've sort of gone below that now. Our unemployment rate is running above its full employment level.
So we just talked about GDP. In other words, how well the country is performing in terms of, let's call it a productivity measurement. Full employment, somehow measured by unemployment and other factors. Let's talk about, and these are Reserve Bank considerations. Let's look at inflation. Mm-hmm. So headline inflation was what we used to look at, or the RBA used to always sort of talk about, and some people still get a bit carried away with it. Some of our politicians do, particularly when it's lower. Maybe you could just explain what they mean by the so-called trim mean or the underlying inflation. What does that really mean? Why has it become much more important?
So it's funny. I know I've listened to a few people say, why do economists have all these different measures of inflation? They just try and take out whatever they don't like for prices. But there are reasons for why we look at a few different things. So there's headline inflation, and then there's what Australia calls the trimmed mean. We also have a weighted median, which is another version of the trim mean. So the trim mean is basically trying to tell you what is going on below the surface. We call it underlying inflation. It takes out the volatilities of headline prices. So, for example, there are going to be volatile items happening all the time. When we had a spike in banana prices might have increased. Lettuce, whatever it was, that's right. Cabbagegate. Egg prices at the moment. That is going to skew what happens to headline inflation. Now, headline inflation is actually what everyone pays. If inflation's running, at the moment, it's running at 2.4% year on year on the monthly figure, that is what you're paying compared to a year ago for an average basket. Again, we can debate, what an average basket is, but for an average basket, according to the ABS, that is what someone's paying. The trim mean will take out the 15% of the top volatile items and the bottom 15% most volatile items. So it's trying to give you a read of what's going on beyond some of those volatilities that a lot of the time we know that those volatilities are not going to persist. We're not going to have a cyclone every month that's going to make food prices go up all the time. We're not going to have electricity rebates continuing forever. So this is why economists like to, what we call, trim those out and just look at below the surface.
So as a better indicator of where inflation's heading?
It gives the RBA, I think, more clarity and more guidance as to where they think inflation's going to settle. And also because it does tend to be less volatile. You could have a situation where the headline figures might run from 3% to 2.5% the next month on a yearly basis, and it's because some of those volatile items that are going to skew the numbers. So the trimmed mean doesn't move around as much, and that's why it gives the RBA a better read for longer term inflation.
So where is AMP at the moment? So just let's look at the balance of 2025. There's the next board meeting when you and I go to air on this one will be in mid to late May.
Yep.
They will have had the March quarter numbers, which come out, I think, probably towards the end of April, sometime around Anzac Day. What are you guys thinking? Are you sort of in the same vein as the money markets now, thinking that we'll probably get another 0.5, 0.6 read for inflation for the quarter?
At the moment, we're at 0.65.
0.65, just a little bit about what I said.
For the quarter.
March quarter.
For the March quarter. I think with that type of number, we will see a May cut.
Right.
The RBA's forecasts are basically somewhere between 0.7 or 0.8. We don't actually know the exact, point estimate that they have, but we can sort of read as to what they're forecasting. But so I think it's going to come a tad below their forecast. But what's probably more important to me is what the components are doing, because we know that the RBA has been concerned about particular parts of the services sector, services inflation, so dwelling construction costs, rents, medical costs, insurance costs, education. And we're seeing really good signs that a lot of those items are starting to soften. So I think it will give the RBA clarity as to how fast that services inflation unwind is progressing, which is quite important for their longer term inflation views. If they're seeing that inflation over the next 1 to 2 years is likely to come in below those longer term forecasts, then that will, I think, give them the room to cut rates again.
So if I could just put it in sort of more layman terms, so if it is a point, let's say if the RBA's guidance is 0.7, they're not giving guidance, but let's say it is. if you just simply extrapolate that forward and just say 4 to 28, that's 2.8, which is below 3, is somewhere between 2 and 3, which is sort of where the RBA wants to see it, trim mean, or the underlying inflation. It's sort of where they want to see it. And if it's lower, then obviously, 4 6 are 24, 4 5s are 2. So like we're in the right territory. So they're looking at, they would like to see 2 quarters of this nice number. We've already got a good quarter in December, 0.5, trim mean. They'd probably like to see another good quarter for March. But that sort of gives them confidence that they should reduce rates. Does the AMP see, maybe ask you this, and I don't know if you're allowed to say it or not, but where does the AMP think that they see the cash rate settling? So, like, are you thinking about 100 basis points from here or 25? And there's only prediction. Yeah, that doesn't mean anything.
They've been quite careful with guiding the market on this, I think, because they worry that people think that this is where the cash rate's going to settle. So when they think about, they haven't actually told us where they think the cash rate's going to end up, but they do give estimates about what they call the neutral level of interest rates, which is basically a guide as to the longer term level of cash rate. And that's somewhere between 3 to 3.5%. Right. And I think our own view at AMP is that the cash rate is going to settle at 3.1% at the end of this cycle. So 1.25% basis point, 1.25% worth of rate cuts in this cycle.
So 5 more cuts, potentially 5 more cuts, 5 more 25, if they're 25 basis point cuts, 5 more cuts. And this cycle, are you talking about this calendar year, or what are you guys thinking is going to be the cycle? Is that between, say, now and June next year? And cycles could be going out longer than in the past.
We think we'll get 2 rate cuts this year.
2 more rate cuts.
2 more rate cuts, so May and August. So we've already had one in February. And then 2 to 3 next year, really.
But do you see one in May then? No,
yes. So we expect a rate cut in May. After the March quarter inflation figures. So we think the March quarter inflation figures will be good again because we already had January and February monthly data, and that was quite positive, a little bit below consensus forecasts and in line with our own estimates. And the full March quarter figures we think will show another good read for some of those problematic services areas. So that's why we think that the inflation data will just point them into the direction of needing to ease interest rates.
So, Diana, could you just explain something that's important? I mean, to you it's second nature, but when you talk about services, what everyone's got to understand is that the inflation is measured against a basket that Australian Bureau of Statistics selects. You and I don't, but someone else selects a basket of the prices and changes in those prices of, they call a basket of goods and services. Mm-hmm. The goods seem to be under control. In other words, price rises in goods in that basket, as calculated or assessed by the Reserve Bank, by the ABS, is performing quite well in the range between 2 and 3. But the services have been very stubborn, and in the services, you mentioned, but we think things like insurance costs, school fees, or education costs.
Basically, rents, everything that you don't want to pay for.
Things. Yeah, correct. And they're not things like this. They're not. They're not tangible things we take away. The services, they've been quite difficult, and a lot of it has to do with infrastructure and stuff like that, and various other policy changes around immigration, etc. have caused these problems, or sort of attributed to these problems. But why are services so stubborn, and is this a global issue?
In the Western world, it's been a global issue. I think in Australia as well, we haven't had as much goods deflation. So deflation is when prices actually go negative. So they go down. Because a lot of people don't even understand when I talk to them, I say inflation's come down from basically 8% year on year to 2.4%. And people say, well, but when I go to the shops, things are still expensive.
Of course it is, because it hasn't gone down because it's just a change.
Yeah.
That's an important point. Could you go through that again?
Yeah, it's really important. So inflation is the change in prices. Just because you've had lower inflation still means that prices are going up. They're just going up at a slower rate.
Yeah.
The level of price changes has been about 20% over the last 4 years. Wages growth has gone up by 15%. So people are feeling this is the cost of living issue. People are feeling like there is this massive gap between the level of prices that they're paying and actually their take home pay. And I absolutely relate to that and understand that. And the government does too, which is why they're giving people back these cost of living rebates. So just because we have slower inflation doesn't mean that price rises are not going to keep
things
going
are going
up.
to become more affordable. Things are going to become
relative to where we were a few years ago.
Yeah,
yes,
correct.
But prices are still going to go up, just at a slower rate.
Yeah, so that's an important point because most people don't get that. They think, oh, inflation's not very high, but my cost of living is still the same.
Yeah.
But of course, because the retailer, just because the inflation number comes out of someone at Woolworths or Coles or one of the big retailers, they're going to say, oh, well, let's now reduce our prices, because that's unlikely because the cost of what they're getting is probably about the same. So it's a margin gain for them. So what we're talking about here is the increase in prices on any one quarter or any one period from the previous period. But it doesn't necessarily follow that a decrease doesn't necessarily follow that the cost of living is going to improve.
We need in wages basically to be rising by more than inflation to see the gap between prices and wages close. And that is possible. In most times, wages growth runs on average in Australia about 3%. Inflation hopefully runs at about 2.5%. So usually we should be getting wages growth running above inflation. And on current numbers, that is actually the case. Wages growth is at 3.2%. Headline inflation's at 2.4%. I know some people won't feel like that though, because again, those painful items like the services that you mentioned, they're still their price growth is still quite high. Rents are still running at over 5%. Insurance prices are running at a similar level. And the reason that services prices are what we call sticky or high at those levels is one, because they tend to lag what happens to other parts of inflation. So because we had an inflation problem in 2022, 2023, services prices take time to adjust to that. Part of the reason for that is also because wages growth increased by such a high rate, and services prices are normally driven a lot by what happens to wages growth.
They're heavily affected by the cost of staff.
Yeah.
Heavily affected because it's usually staff that provide the services.
Yeah, that's right. And with things like insurance, they're going through their own industry-specific problems around climate change, very high premiums, the cost of stuff overall. So I think there's some industry-specific things that are also happening. Healthcare is related to our aging population, high immigration or high population growth. So there are broader macroeconomic factors that also influence what happens to some of these services areas. The good news, though, I think, is that those problematic services areas are slowing. They're just not slowing as fast as the RBA probably would have wanted them to. But I think that in the past 6 months, a bit of that has changed. The new dwelling construction cost, or the cost to build a home, has come down a lot. Rents has definitely reached a peak. You can see that in the new asking rents. We're getting more supply into the market. Immigration levels are going to slow. So the rental market's going to look much better for a renter in the next 12 to 24 months.
If and it's my final question too, but if Australia was looking for the Goldilocks period, like when, and in terms of economics, I'm talking about when inflation is and has been for a long enough time traveling at a number lower than wage growth, and let's call immigration out as immigration has settled down from where it was back to more normal numbers. Does someone like the AMP, or do you have a general sense, when do we reach that Goldilocks period? In other words, if we're paying 20% more for everything that we're buying and using, just by way of assumption, and but now we're going to pick up the difference of the new increase in prices of 2.4% relative to our increase in wages of 3%. Mm-hmm. Let's take bracket creep out for a second. 3% wage growth. Do you guys get a sense of when do we achieve our catch up? When does Australia as a nation achieve its catch up? Forgetting about interest rates and mortgages and stuff like that. But when do we achieve our catch up? Is it like a straight line thing? Like, we've had 20% increase. We're only going to pick up a difference of 1% per annum. So if we're going to wait 20 years to catch up, or is there a sense of this down the track?
It's about 5 to 6 years if wages growth runs at the levels that we think, 3.25 or so, and
sort
inflation.
Of compounding.
Yeah, that's right. Yeah. So in the early 2030s, basically.
Yeah. So really, we should get back to that normal period, normalization, somewhere towards the end of this 10 years, the end of this decade. making some assumptions, of course, that we should get back to what is normal. So maybe Australians have just got to buckle down and just hold on. That's all you can do. You can't hope the government's going to change your prosperity overnight. They can give you electricity rebates and all that sort of stuff, but they're not going to change your prosperity overnight.
I think Australians should just focus on trying to build their own wealth as much as they can, trying to think about investing for the long term, the benefits of compound interest. So really it's about getting yourself more literate, financially and economic literate, to try and understand what's going on in the market, try and get the best deals that you can for your mortgage, understand what's happening when the cash rate declines and your mortgage rate falls, trying to ask for discounts on those things. Look at your super, trying to make sure that you're invested in the right fund. So it's really all about making yourself more literate to build your wealth.
Yeah, and I think I'm not here to plug AMP, but that's the thing. Like you made a very good point. Australians just can't sit back and wait for someone else to solve for them.
No one's going to do it.
You've got to educate yourself.
Yeah.
So does AMP, your whole group, do you do publications, etc., that people can access? Is there stuff that
Absolutely, we do, yeah. Our team, the economics team, Shane Oliver, me, Boy, and myself, we publish a weekly report, multiple reports a week. We have a podcast channel that people can listen to.
Where do people access this stuff?
On normal place you can access your podcast. We're called Simplifying Investing.
Simplifying Investing. That's I guess it's on Spotify and
iTunes. Apple Podcasts, YouTube. Or you can follow Econocides, which is our economics channel on Instagram, TikTok.
Econocides?
Econocides.
Sites.com.au?
That Econocides is our tag for all the social media stuff. So we do short form videos, trying to make people more financially literate, talking about the data, talking about politics, basically a fun way of relating economics to the everyday person so that people understand actually what's going on and what it actually means for their own wealth.
And I think that's the whole purpose of my show, is to introduce people like you to the audience. But the audience, is up to you to do something about it. So you're not going to learn about everything now, sitting in this room. Just this really an introduction to Diana and the team. By the way, Shane Oliver is one of the best. So you've got to do something about it. And you've got to go. That's why I'm asking you, where can they go and access these things? Because people don't know. I wouldn't know. I read stuff all the time, but I didn't know that you had this Econocides hashtag.
Yep.
I didn't know that you had. I didn't realize you had a social media environment at all. So
that's how your team found me.
Yeah, my team. Yeah, well, that's what I don't know. But my team found you. Yeah, but that's the point. My team. That's their job.
Yeah,
is to hunt for people like you and bring them to the show. And our job is to take you and put you out in front of everybody. But at the same time, people need to know how to access you, because you might not be on this show again for another 12 months. So, and you got other stuff to do. But what's important is that people, and what's interesting here is that you're not selling them anything. You're not trying to sell them anything from AMP.
No.
I mean, you're not a salesperson. You're in the policy division of an organisation that just talks about the economy, and that's really important. So, Diana, I really appreciate coming on. Thanks very much for doing
Mark.
that.
It's a pleasure.
And I think it's important that Australians know that, and it's good that you're female too, that we have economists here who want to share with us their views on how to improve their lot. And having a female for a change, we haven't had one on talking about economics for a long time, other than from Westpac. But I appreciate it a lot.
Thank you.
Thank you.